Welcome back. My name is Arya and I don't waste your time, so let's get straight into it. Ladies and gentlemen, in today's video, we're going to be doing victory laps on what I like to call is my best investment ever, which isn't saying much. Granted, I've only been investing for about 2.5 years, but nonetheless, in these 2.5 years, I've made a laundry list worth of mistakes, whether they be errors of omission, not investing in meta platforms because of my personal bias, down at $100 a share, selling winners too soon. I sold Microsoft in the mid 200s before it ran all the way up to 400, or mistakes where I would buy into a stock with unreasonable expectations only for that stock to start falling from the point where I bought into it. For example, Starbucks, I bought it at, I believe, $85 a share, and then in the ensuing quarter, they had the disastrous meltdown downwards, revising their guidance and their growth estimates and all that type of stuff. I'm sure you guys remember. But nonetheless, ladies and gentlemen, in today's video, we've had one stock that I've put nearly 30% of my net worth into, and it turned out to be right. And it turned out to be right in a very short period of time. Of course, that is Salesforce.com, which is the customer relationship management software. I've done a very lengthy 1 hour long video talking about what it is and why it's a powerful business and all that type of stuff. I'm going to link it in the description. It'll be in the corner and it'll be on the screen at the end of the video if you're interested in that. Long story short, to kind of catch you up if you don't know what it is, businesses have information about their customers and their suppliers and all that type of stuff, and they need to store that information somewhere and keep it organized. You kind of think of it as like on a personal level, you might store, for example, your credit card transactions and track it over time on like a spreadsheet. For businesses, obviously, they have much more complicated needs, and so they need what's called a CRM system in order to track all that information and store that information, all that type of stuff. And so this is kind of what it looks like. It's a dashboard. It's on the cloud. I think you guys kind of get the idea. And I should mention, I didn't initially get the stock pick correctly. Actually, when I first purchased into the stock, it was earlier in the year, around the March timeframe. I think actually at the end of February, February 27 or so was when I first purchased into the stock. And it was right around $300 a share. They had just had this quarter, completely blew estimates. Margins had expanded. It was just a very beautiful quarter. And so I had been watching it for a little bit for the past couple months. Things have really started to improve at that point. And admittedly, I had somewhat FOMO'd into this position. I had just seen the complete blowout quarter that this company had reported. I believe it was the Q4 report that had just came out at the time. And so it was a continuation and like a guidance towards this company is becoming very lean, and they've completely transformed the business. They've gone from a very wasteful company in previous years, whereby in the blue here, for example, the stock-based compensation made up more than half of the free cash flows that this business was producing, all the way to it at the time was accounting for a little bit less than a third of the free cash flows. They'd done this in two different ways. One, they had actually decreased the amount of stock-based compensation that they had issued, so it went down by roughly 500 million. And additionally, they were able to increase the free cash flows in that same period by roughly 15% in a matter of a few quarters. Just absolutely amazing stuff. It was a true path towards massive profitability, something that this business hadn't proved in the past, running in somewhat like a wasteful manner for massive revenue growth and that type of stuff. And again, in the same time frame, you could see the free cash flow margins going from a trough of about 18% all the way up to 27%, and then we've seen the continuation of that. It is now sitting at 32% free cash flow margins. Very healthy free cash flow margins, particularly for software business. That's about where it goes to. If you look across the board, software companies kind of peak at around the 30%-ish. Maybe over time, as the company matures more and more, you might look closer to like a 35 or like a high 30s free cash flow margin, right? And so that's when I kind of chased and FOMO'd into this business, just shy of $300 a share, late February. I bought into the company, and that's actually around where the stock peaked. In the ensuing, call it month and a half, in spring, as the months passed, reportedly, and this is one of the reasons why the stock was actually up initially, they said they would stop doing a lot of wasteful acquisitions. Reports came out that they're going to essentially overpay on this company, Informatica, and so the stock dropped by roughly, I believe, 7-8% that same day. So I bought a little bit more after that little drop, because I built a decently sizable position, give or take 10% at the time, and so I bought a little bit more when the stock price obviously went lower and lower, and I was rewarded with a tiny little rally in the ensuing, call it, month. And then, ladies and gentlemen, the opportunity of probably, I don't know, call it half a decade presented itself. On May 30th, Salesforce reported what seemed to me was a very good quarterly report, and the stock dropped by about, I think it was 21% in the span of literally a day. And why did the stock drop by 20%? 20% is, particularly in the land of mega cap businesses, that's a lot of market cap and a lot of investor dollars that are going to be wiped away in the span of literally a day. And so the big reason that the stock had dropped on that day was because they had missed their revenues by, I kid you not, 0.2%. It is because they had missed their revenue estimates by, I kid you not, 0.19%. Quite literally a rounding error. When you refer to how much Salesforce did in revenue, you probably just read maybe the first decimal. It was literally a rounding error, and that's why the stock had dropped 21% on that day. Of course, the big reason as to why that was such a big scare is because this company hadn't missed their revenue revenue since 2006. So again, understandable. The big software company that is just now turning the wheels on massive profitability and shifting their focus away from growth. The revenue has been slowing and they just missed on revenues for the first time since 2006. Justifiably, the stock should be down, but 21%. And so at the time, the finance Twitter space took it and ran with it. And you have big name YouTubers who are fund investors of Palantir. Palantir somewhat adjacent, although with the people that I've talked to, they're not really head-to-head competitors. A little bit on the analytics side. I don't know. At this point, I really don't know. But anyways, you have these big name YouTubers that are tweeting about it, kind of ridiculing Salesforce, calling it a fake AI story and saying it's a dinosaur business. The days of software dominance for Salesforce is over, talking about the bad AI products and that type of stuff. Oh, does it even add any value? So on and so forth. And to be quite frank with you, it was a very gloomy day to be a Salesforce investor. This company that at the time, I didn't have a 100% cohesive understanding of. Of course, I knew it and I played around with the software, that type of stuff, talked to a lot of people. I did my due diligence to the point where I'd be comfortable with exactly a situation like this because, anything could happen in the stock market. But at the end of the day, it wasn't a business that I understood to the point where I understood Amazon or to the point where I understand MasterCard. I at the time, at least, I knew the ins and outs of those business. Now, of course, I have a very good understanding of Salesforce, but nonetheless, I stuck to the course and I actually ended up buying a lot more. In fact, in the ensuing, call it 2 weeks after the stock dropped by 20%, I doubled my total share count. So I technically doubled my position. Of course, in dollar terms, it was roughly like a 40%-ish, give or take. Maybe I'm messing up the numbers here, but nonetheless, you get the idea. I quite literally doubled my share count, right? Reason being, this was a stock that was trading at literally the all-time low valuation. And so I believe it actually slid down a little bit more for you people who like using the free cash flow yield method instead of price of free cash flow. At the time, this was, I believe it peaked at a 6.6% free cash flow yield, right? So, take high interest rates or whatever the case is, you could make a risk-free 4.5%, 5% for the next 10 years, or you could buy into Salesforce today, making 6.5% free cash flow yield. Never mind the fact that those free cash flows on a trailing basis were growing at about 50%. And then on a forward basis, call it, I don't know, the next 10 years, let's just say 10% growth, right? That was the opportunity. That was the opportunity that you might not get for the next, I don't know, probably 5 years. A business that is so sticky, that is so powerful, such a wide moat, with so much growth left in the tank, and yet it was trading well above what the risk-free rate at the time was trading for. And, if you adjust out stock-based compensation, again, I'm just going based off memory, I think it peaked at about 20 times adjusted price to free cash flow or a 5% free cash flow yield, right? And I made countless tweets kind of talking about this. Maybe we could go through it. In fact, this is one that I commonly refer back to, is I pointed to the fact that, you guys know I don't really do technical analysis like that in depth. Maybe just to start a position, I kind of look at it to try to see relative to, the recent price action, how it's doing. Obviously, I'd prefer to get into stocks a little bit cheaper, but I went back and I looked at it. This red line here is the 200-day weekly moving average, and Salesforce had only traded at the 200-day weekly moving average 4 times in its history. So I highlighted every single day that this had happened, and if you bought into the stock and you waited, what would your return have been? And every single time, without fail, the return would have been absolutely wonderful, except for the recent 2022 bear market. But even with that, if you look at it, had you waited, I don't know, an additional month, your return would have been remarkable, right? So point still stands. If you wait around a year and a half with every single time that this had happened, you would have had a phenomenal return, definitely outperforming the market by a wide margin. Furthermore, I made tweets talking about why it has a wide moat. This is something that I typed up in my friend's Discord server, kind of giving you an example of what it actually does, why it's powerful, all that type of stuff. This is another tweet that I made. 5.65% free cash flow yield, trades higher than the S&P 500, and yet it was growing at the time 43% year over year. And so I would go on here, but I think you guys get the point. The stock went down by a lot, unreasonably so, in my opinion. And a lot of people ridiculed me and, Salesforce investors, Salesforce, the company itself, calling it a dinosaur business, can't innovate, existential crisis with AI, whatever the case is. A bunch of different narratives all of a sudden come out of nowhere as soon as the stock goes down. Very easy for outsiders not familiar with the business. It is a complicated business at the end of the day to kind of dump on the company just because the stock is down, right? And you know what? I've made that mistake in the past myself. There's been a lot of companies where as soon as it goes down, I start to criticize it. We all kind of fall into this trap. So I'm not really picking on anyone in particular, but nonetheless, I think this serves as a valuable learning experience for everybody. Just because something's down doesn't necessarily mean that it's justified, and at the same time, it doesn't necessarily mean that it's a valid buying opportunity, right? I think the big takeaway we could have from this is you need to formulate your own opinion and actually dive into the numbers for yourself. Of course, at the end of the day, you should be watching YouTube videos that are maybe condensing all this information for you and that type of stuff. But at the end of the day, that shouldn't be what you kind of formulate your opinion based off of. Maybe that should be the entrance to you being like, oh, that's interesting. I didn't know Salesforce is growing at 60%. Maybe I'll look into that to kind of see oh, okay, it's a margin expansion story. It's not going to continue forever. It'll continue at maybe a 15% clip in the future, right? So these are kind of things that you should be taking inspiration from to kind of go look at for yourself. That's ultimately the number one thing that I want to teach through my videos as a whole. Go figure it out for yourself. Don't just just look at somebody else's opinion and there we go, we're going to run with that, right? It's like the narrative-based investing that is very, very dangerous in my opinion. And so with all that being said, there's another company currently in my portfolio that has recently fell, give or take 22% within a span of 2 days. And over the past, call it month, people have been ridiculing this business, saying the moat is over, they can't figure it out, the customers are being hesitant. It's ASML. And ASML, I've done 2 repeated videos. It's, if you just click on my channel, you'll be able to spot them pretty easily. I'll link it in the description as well. But this is a company that probably has a wider moat than Salesforce. They're the only company on earth that could make the lithography machines that they make, and they're mission critical to literally the world. They have to exist. If technology is to innovate in the future, ASML must exist and must make better machines. And they've done that over the past, call it 4 decades. It's a very, very important wide moat business. Again, I'm going to highly encourage you to actually go check out the videos that I made on it, kind of pitching the stock and covering what's going on with that business. And this is a company that I've done repeated buys into over the past month as the stock price has slid. So actually I have my position from September of last year, which was about, I believe, $590 a share when I first bought into it. And then I've made 4 equal sized buys into this company. So I have the original shares from last September, which they're in at a really good average. Then I bought at $800 a share right before the earnings. I bought right after the earnings at about $700 a share. And then I bought in yesterday like $670 or something like that. And so the average with ASML today sits at just shy of $700 a share. And again, similar to the Salesforce story, I'm going to just wait it out. This is a very important business to the world. Just because they have one bad quarter and just because there's a couple things that are incorrect with the assumptions that I made going into this holding, I'm not going to sell it just because of that. I'm willing to wait it out. I trust the analysis that I did up front. I think it's going to end up outperforming the market in the future as long as I'm willing to hold it for a lengthy period of time. It's a very, very wide moat business. I still think it's deeply undervalued. I'm going to, just because I already have like give or take a 10% position, I'm looking to pick up more shares closer to the low 600 range. I would at most bump it up closer to maybe about 15% of the portfolio. I have good enough exposure to it. I'm happy with what I have so far. And also, if you've been wondering what this beautiful software in front of you is all video long, it's finchat.io. You could try it out completely for free with the link in the description down below. Of course, the version we're looking at is the full functionality premium version, but nonetheless, there's a bunch of great stuff on there if you want to just check it out. Again, no obligations of payment or anything like that. And then to kind of wrap up the ending of this video, this is the current state of the portfolio as of November 5th, so yesterday. And I don't know, just to do like a quick rundown of each and every one of the holdings, you guys can kind of see like I follow a very concentrated quality growth strategy. Obviously, I want all these businesses to be able to grow their bottom line at give or take 15% or more. The only one that kind of stands out, which is a very speculative position that I opened recently, is TMDX Transmedics. This one, I'll just say it straight out the gate, I was motivated to, again, look into it for myself because of Brian Stoffel. Because of Brian Stoffel, the YouTuber. He's done a bunch of great videos on this stock. It's a very fast growing stock. And I think it does have a narrow moat currently, but I think it's going to have a very wide moat in the future as they scale and become bigger. I'll do a dedicated video on that in the future. With that being said, Amazon recently broke $200 a share. I've been expecting this for a very long time. That's also a very undervalued business relative to the cash flow that it has been producing in the recent, call it year and a half. Salesforce, we've been talking about all video long. Google, I'm a happy owner. They recently did really good on their earnings, cloud reacceleration, all that type of stuff. Just absolutely brilliant. ASML, again, I believe it's a very undervalued business at the time. MasterCard, I'm just happy to hold it at the time for the time being. I would like to add to that position just because I initially wanted it to be about 12-13% of the portfolio. As I've continued to contribute to the portfolio in absolute dollar terms, it's kind of slid down and that type of stuff. With that being said, if you're interested to watch the Salesforce deep dive, hour long, going through everything, the thesis, the valuation, all that type of stuff, you could do so here. And then if you're interested to watch the ASML video, it's going to be right up here. Thank you very much for watching. Be sure to subscribe because it costs you nothing. Have a great day.